You're watching Personal Finance with Coach Kelvin. Let's get into the video.
Hey guys, Coach Kelvin here. And today I wanted to talk to you about a particular ETF which has announced dividends last month to be paid this month. And I think most of the shareholders which actually hold this ETF would be quite upset or disgruntled at what's actually happening. So I am of course talking about the iShares S&P 500 Australian Hedged ETF. Now the ticker symbol for this is IHVV. Now this particular fund is issued by Blackrock and iShares, as I mentioned before. And it's quite interesting because to hedge this fund, you actually hold the ETF IHVV, which is just the unhedged version of the S&P 500 fund through Blackrock. And then you hold a lot of cash derivatives. So I'm going to take you down to what the holdings are on this page. All right, so if we look at the top 10 holdings, which is actually the only holdings, 10 holdings in this ETF, you have IHVV, which is the actual core holding of the IHVV. So you have IHVV, and then you have AUD cash and USD cash. So that is balancing out the cash fluctuations between Australian and United States currency in order to give hedge returns back to the shareholder. Now, what's very interesting in this is that any change of currency or sell of assets within that ETF, they then need to distribute all of the profits or all of the gains. They need to distribute that to the holder of the ETF as a distribution. Now, this is where things get a little crazy with this fund. So, if I come up to here and we actually have a look at what the distribution was. Now, the ex-dividend date for the 1st of July 2021 to be paid on the 13th was 9,198 basis points, which essentially equates to $91.98. So this particular ETF, okay, at current time has a price of $425. Now, the price actually dropped that $91 as soon as the ex-dividend date hit. So essentially shareholders received back 20% of their investment, or just slightly less than 20% of their investment back as a distribution, which they're forced to then pay capital gains taxes on because there has been reshuffling within that portfolio. So you're essentially losing a lot more money than you would have had the share simply not paid out such a large dividend. So what I think would actually be a far better strategy in this case is to have held IHVV, which is the actual unhedged variation of the S&P 500 index through Blackrock. So because of that extremely large drop, okay, in the share price, this could be advantageous to people if they were looking to change from the hedged ETF into the normal one. So you could simply sell at a loss to lock in some capital loss to offset the capital gains portion of that dividend that comes through IHVV. And then you could buy back into IHVV because it's a different ETF, so it wouldn't count as a wash sale. But there may be some tax implications for that, or it may not actually be too appreciated. So definitely check with your accountant before making any moves like this. But to buy back into IHVV the same way, you would have to wait at least 30 days for this to be legal. Now, the problem with this is you're forced to pay a large taxable portion of that dividend because of the capital gains component, yet you haven't necessarily held those derivatives, etc., for more than 12 months. So you won't even get the capital gains tax discount. So if you were to have, say, 10 shares of this particular ETF, you would be receiving $910 back, and you'd be losing, up to 37 cents on the dollar in tax potentially. So it's very important that when you have an ETF like this, you need to basically know what it is you're investing in and why you would have a hedged investment. So I feel like if you want to hedge the currency, perhaps hold half of your international exposure in an unhedged variation of that ETF and then half in a hedged variation. So you can ride out some of the volatility of the different markets moving. When the Australian dollar performs very well and the reshuffling of the currency within that portfolio happens and you receive a bigger dividend, you can then reinvest that elsewhere. But when the United States currency does far better, your distributions through the hedge variation will be less, but more through the unhedged. So this could sort of balance it out. But I think most shareholders who actually hold IHVV will be very disgruntled as to this particular circumstance happening. Now let's talk a bit more about this fund. So overall, it's actually not too bad. The management fee of the IHVV fund is only 10 basis points. Now this is the same as the Vanguard Australian shares, etc. So if you're looking to hold the S&P 500, paying $10 as a fee out of every 10,000 invested is actually not too bad. But when we compare this to IHVV, so the unhedged variation, that has a management fee of only 0.04 or 4 basis points. So only only $4 fee out of every $10,000 invested. So this is actually a much lower fee, and you're not going to lose half of your dividend. You're not going to lose 20% of your holding through a dividend payout and have to pay a large taxable portion on it. So that's potentially something to think about. Now, for someone who doesn't hold IHVV, while it's on such a discount and it's down to $425.94, this may be a better buying opportunity than it was potentially, a month ago, where it was over the 500 mark. You're essentially getting a 20% discount. But understand, as those funds build up and the Australian dollar continues to potentially perform well, this same scenario could happen again, and the underlying assets within that fund will become less and less and less as more of its distribution is paid out at a large percentage. Alright, so I think that's worth noting. Now, if you were to hold just simply the IVV variation, so the unhedged variation of the S&P 500 index through Blackrock, not only are you losing less in fees, you're going to have more capital growth, therefore a lower taxable portion on this fund until you actually go to sell. When you hold it for more than 12 months, you get a 50% discount on the capital gains component if you sell after the 12 months. But if you don't sell, you don't have to lock in any capital gains. You just simply pay income tax on the distribution you receive. So I think if you were so concerned about hedging against the international market fluctuations, definitely have a portion of it. But I think part of the appeal of an international exposure is so that it is non-correlated to what your home bias economy is doing. So potentially having maybe 20 to 50% of your international exposure hedge makes sense, but definitely not 100%, because I feel like that's going to eat up your investment returns, as we can see here, and it's going to leave you with less capital invested, essentially stunting the compounding effect of having your money in the market over the long term, because so much is getting lost in tax. So you're not actually able to keep reinvesting at the same rate as if it was not being taxed. Of course, you could set it up so that you reinvest these dividends and just buy more of IHVV, but you'll still get a tax bill at the end of financial year, so that's worth noting. Now, if we look at the overview, why IHVV? You get exposure to large established US companies. It is low-cost access to the top 500 US stocks in a single fund, and you can diversify your portfolio internationally while seeking to minimize the impact of the Australian dollar volatility on your returns. But as we saw, that can be detrimental with such a high payout ratio. Now, we're going to have a look at the performance of this fund. All right, the total return, since inception is 13.71% compared to the benchmark of 13.68%. So, a return rate of 13.7% per annum is very good. And you'd almost double your money every 5 years. So that is a phenomenal investment. However, that's probably not taking into account the insane dividend we just received for anyone who holds this fund. So that will definitely change the numbers after that payout is received. Now, the benchmark has actually underperformed what the return of this fund is most of the years that are listed here, okay? I'm not exactly sure why that is, but it could be coming down to the lower potential dividend payout when the hedging does not favor the ETF holder. Now, we want to look at what the total return for this financial year is, okay? If we look at the return of the ETF, that's 38.54, whereas the benchmark was only 38.14% return. Still a phenomenal return. But if you look at that difference in 0.4% return, that is actually a huge amount when we think about it. So the fund outperforms the benchmark, but look at how much you just paid in a distribution. So you can almost wipe out what that difference is once you actually accommodate that tax bill. So it's very important to understand, just because the graph actually shows this or the table shows this, it may not be the true outcome. Unless, of course, you were earning less than the tax-free threshold and therefore you didn't have to pay tax on that earning. Now, we can see here that previous distributions, so July of 2020 was $7.25. That is far more reasonable. July of 2019 was $0. And so when you get a $0 return for the distribution, you're not paying any income tax on it. Of course, the funds are being reinvested and growing the expense or the cost of that fund. But then again, if you were dependent on a dividend income to live on, that would not be ideal. So this is where sort of a balance between a hedge and an unhedged variation of the same ETF may work for you, so that you can definitely lock in some dividends in the unhedged version, but the hedged version will sort of behave very differently, okay? Now, that is pretty much IHVV. We're going to have a look here. So the assets under management are $562,916,816.25. The shares outstanding are 1,321,000, and it was created, or the inception date was the 15th of December 2014. Now, this is available on all markets, but the ASX is where you buy it. You can obviously buy it you can purchase Blackrock shares on other exchanges as well. Now, the exchange ticker, IHVV, as I mentioned before, has other ticker symbols relating to it. The rebalance frequency is quarterly, but the distribution frequency is annual. So even though it may rebalance every 3 months, you only get paid out once per year. So every time it realizes some sort of capital gain and has to hold that cash, it's not paying it out to you, so you can't reinvest it, yet it has to pay it out because it's an ETF. So it sits on cash for potentially 9 months before you receive your distribution. And this is called cash drag. Now that means that cash is unproductive for the time until it's paid to you or it's reinvested. So therefore, this does have a bit of problem behind it. You obviously want your cash to be productive while we have it invested. Now, this particular fund is obviously domiciled in Australia, therefore it pays out in Australian dollars. But it's important to know that because it's hedged, whatever the Australian dollar does can heavily influence the payout ratio and everything like that. So it's very important to look at. So I did a little search on this particular ETF. It came up with something else, but we're going to look at the Oz Finance subreddit. So I looked at this Australian hedged ETF distribution where someone has asked why IHVV, so this was the 2019 distribution I believe, had a 0 cent distribution. VGAD also a 0 cent. So one of the comments down here was that VGAD, so I assume also IHVV, couldn't pay distributions when the currency has fallen. They have to pay the hedging cost out of the dividends. So therefore, the hedging cost is lost because the dividends are eaten up by that. So that's also something to consider. If you're not receiving a dividend distribution from your hedged ETF, that is because that is being used to help hedge that money. Therefore, it grows the balance of the fund, but you're not receiving cash back if that's what your goal was. Now, hedging losses in the fund will outweigh any income earned. Therefore, it cannot be in a position to pay the distribution because it's in a tax loss position for the year, and there is no net income to distribute. The fact that hedging gains and losses are treated as income and expenses means that from year to year, distributions can fluctuate significantly more than unhedged funds. So again, something else to consider when looking in buying hedged or unhedged funds. Now, not everything you read on Reddit is going to be very high quality information, but understand that you can come to the Oz Finance subreddit and have a little look, and you can generally find answers to most of your questions. So you just come here, hit the search bar, and chuck in there whatever it is you want the answer to, and hopefully something will come up for that, okay? So guys, that is my little talk about IHVV. If I was a shareholder in this fund when it was in the 500 mark and it paid out 20% of my capital as a dividend, I would be pretty disgruntled because I wouldn't want to have such a tax liability based on the sale, or on the dividend from the capital gain sort of distribution of that. However, if you relied on that sort of money or you wanted to redistribute it and invest into something else, there's potentially an opportunity for those who did own it. Who knows though, now that it's at a significant sale price, it may be worth looking into. I'm not a financial advisor. So do your own research before buying anything. But this could be a buying opportunity if you are that way inclined. Alright guys, so I'm just going to do my purchase of stocks for the month. This is from my rental property in June, all of the money I've got in this account. So I'm just going to make my purchase now. So the first share I'm going to buy is VAE. I have some free trades from a referral, so I'm actually going to make 2 orders today, okay? Went to do a buy order. Now I'm just going to scroll down here. Now I'm going to go off value. So I've got in the account $1,484, okay? So I'm going to sort of do a split to rebalance my portfolio slightly here. So I'm going to put $900 into VAE with a limit of $82. So that's going to spend 820, okay? So I might as well just round that up and make it $902. So I get 11 units. There we go. Awesome. So then I'm going to scroll down here. I'm going to go review order, aligning with target portfolio, bullish, confirm order, and that should clear and purchase for me today. Very cool. There we go. Field already done. Now I'm going to scroll down, come back to place orders, and place another order for VEQ. Okay. There we go. I'm just going to put all my remaining balance into this one. So again, value, I've got left $592.08. My limit is going to be $64.30. Oh, $64.30. There you go, and that's basically going to spend everything I've got. I've got 9 units here. I'm going to scroll down, review order, aligning with target portfolio, and confirm. Alright, done. And that should hopefully clear today as well. So it's unfilled right now, but that will eventually just go through if the market matches. Alright guys, so those are my 2 orders for today. I had free trades, so I had no problems doing 2 trades because I didn't have to pay any brokerage fees. However, if I have to pay brokerage, then I usually don't do 2 trades in a month. I'll try and stick to just one and put more money into one fund at it. Alright guys, thank you for watching this video. I hope that gives you some sort of insight as to how a hedged ETF works, because it has to sell the currency derivatives in order to make the volatility of the dollar less on the performance of the fund. But as a result, they may have to pay out a higher distribution, which can increase your tax liability. That's the summary. Alright, if you got any value from watching this video, please like, share and subscribe. Give a comment down below if you actually have bought a hedged ETF and what your experiences are with that. Do you like that it can pay out more, or do you dislike that? Who knows? I for one do love receiving my dividends every single 3 months, and I love increasing that over time, but not when I'm having to pay out a lot more of a tax liability as a result. Guys, I really look forward to seeing you in the next video.